Okay, we're done talking about the 17T. Bye. We'll see you. I want to bring up a couple of things that are pretty important for you. One thing is, I know those that were here last fall, we did a lot of training on the grant schedule, the CEFA schedule. And I did want to bring up to you, as we said or indicated last year, we're not compiling that anymore. Now, you might have had auditors who maybe helped a little bit more than what you thought they would, but the fact of the matter is that if you haven't actually compiled and put on the gateway, this becomes a material weakness. And so you have to understand that they have to look at it that way, and that you may have a finding in regard to that. And also, if there were a lot of adjustments that they had to make, that you could potentially have a finding. So what I think that you would really benefit you a lot is when they come in, if there are a lot of adjustments, or if for some reason you didn't get it on Gateway, talk with them and find out where your shortcomings are on this. Don't just take the finding and run with it. Now, we talked last year, like I said, we had a checklist. You need to keep things in folders, you know, the difference between reimbursement and advance. That would be great to have that policy. I also know that some of the counties contacted me and they were having difficulty implementing those policies. So I do understand that there's a transition that's going on, but I did want to forewarn you and want you to open up some dialogue with your auditor. Don't just accept it and go, well, you know, we'll figure it out later. Find out what their thoughts are too. And then this fall, we will have some additional training when it comes to the CEFA report. Affordable care. Oh, wow. I know I could talk forever about that, but really I couldn't because I know nothing about it. And I don't know how much you all know about it. But I do know that we've been getting the question, and there will be an article in the July bulletin, but we've been getting questions about the penalty, you know, whether we're going to hold you responsible for that. If your commissioners have made a decision, it's a management decision, that this is the direction that they are going to go because it's in the best interest, the best business interest of your county, then that's not something that we're going to take exception to. Now, I know that's a little different than how we normally talk about penalties, but this is a little bit different than your normal penalty. I mean, the Supreme Court has, at least the last that I heard of it, is they were considering it a kind of tax. There's a lot of confusion on this. And so until things are better defined and the federal government has better definitions and processes and things in place, we just wanted to let you know what our audit position is here in the near future. And finally, and this is not really new, it's just something you should be aware of, because you know that we went to the regulatory form of financial statements last year. In your opinion, we have added a sentence that says management is responsible for and has determined that the regulatory basis of accounting as established by the State Board of Accounts is an acceptable basis of presentation. This is something that we're required to disclose, and so we wanted to make you aware of that. Last year, you know, you did sign to say that we accept, you know, these are our financial statements, this is our presentation, but now the opinion is formalizing it, And then you also have another form, which is management oversight of non-audit services. And that's a form that you fill that you're basically signing off and saying, yes, we agree to all these different things, and we have similar language there. So that it's just very clear to everyone what basis of accounting is being used, and that you understand that, and that that is the basis of presentation that you're comfortable with. So. Okay, as promised, we'll go over in detail about changes brought by Senate Enrolled Act 152 and House Enrolled Act 1545. And this is where that Andrew was very instrumental. He recognized an issue, and he went and he talked with the legislators. So now he said it might have been a little overkill having it in two bills, but I think we should all be just grateful that we got a lot of clarification on this. So thank you, Andrew. I see you still back there in the row. Anyway, these two bills, we're going to talk about how they impact tangible property tax refunds, and that are also entitled to interest, so it is kind of a narrow focus, and the changes that we made to this Form 17T to accommodate these changes. And luckily, like I said, both of those laws have the exact same language, so we don't have to worry about two different versions and two different implementations on those. Specifically, the changes impacted IC 6-1.1-26 and IC 6-1.1-37. And when I talk about 37, you'll also see that this means that there was an impact on IC 6-1.1-15. So let's go over IC 6-1.1-26-1, so we're all on the same page here. IC 6-1.1-26-1 is where a taxpayer files a claim for refund for a portion or all of a tax installment that they have paid. The claim must be filed within 3 years after the taxes were first due, on a form prescribed by State Board of Accounts, which is the 17T, and based on one of the following grounds: taxes on the same property have been assessed and paid more than once for the same year, the taxes as a matter of law were illegal, or there was a mathematical error either in the computation of the assessment upon which the taxes were based or in the computation of the taxes. So when a person files a claim for refund, they have to be based on one of those criteria under the code for that. And of course, the claim has to have the proper approval, which we'll go over that in a little bit when we go over the form. So here the person is entitled to a refund plus interest. Closely related to this is when under IC 6-1.1-15-11, a taxpayer is entitled to property tax refund or credit because an assessment is decreased. So through the process under IC 6-1.1-15, they are entitled to a refund, and this means that they are also entitled to interest as found under IC 6-1.1-37-11. And also included on here for background, I have IC 6-1.1-25-10. This is the other case where there's a refund plus interest and where the Form 17T is used. And this is for invalid tax. I just want to let you know here that the changes in the interest that we're going to be talking about did not impact invalid tax sales. The interest, when you have a refund in this case, is still 6% per annum for the amount paid by the purchaser if it is found by the county auditor and treasurer that the sale was invalid. And of course, the Form 17T is still used. To make it a little more clear, I know there's some of you that are new and maybe you haven't been impacted about this yet. Before we talk about the changes made for this year, I think we should kind of go over what happened last year. Effective last July 1, 2012, with last year's legislative session, IC 6-1.1-26-5 was amended. And of course, it seems simple at the time, but those of you who started trying to apply it this year found that it was anything but simple, and you had some really good questions that we couldn't answer. So that's where Andrew came in, and he worked for some of these laws changes. And of course, these changes also resulted in changes that we needed to make to the 17T form. Before the change last year, to kind of give a background, IC 6-1.1-26-5 read, and this is before the change last year, that when a person is allowed a refund of all or a portion of their tax installment under IC 6-1.1-26-1, interest at a rate of 4% was also to be paid to the person. And the amendment last year changed the 4% rate to the rate established by Indiana's Department of Revenue's commissioner. To clarify about that, this rate is by statute what the commissioner each year must establish for under and overpayments received by the Department of Revenue. And this is based on an average investment yield for the previous year plus 2%. It takes effect on January 1 of the immediately succeeding year. And this can be found, and this is kind of a tricky place to find it, but this can be found on the Department of Revenue's website at www.in.gov/DOR. Under libraries, it takes some searching to get to this, under libraries, under departmental notices. And I did make a promise that I didn't keep last year. I just blew by it, but we will have this in January's bulletin. And as a matter of fact, we're going to keep, because, and you'll see what I'm talking about, we will keep for several years the different interest rates that are in effect in the bulletin. But I also want you to be able to get to that site yourself. So effective last July 1, 2012, we had that amendment to provide that the interest rate was no longer a statutory 4%, but was the rate determined by the commissioner. But the question was asked, since this means that the interest rate per each year is variable, what is the interest rate applicable since the amount refunded may be over a span of several years? Do you pay the interest rate in effect on the total amount that the date is claimed, which has been the kind of the norm? Do you pay the interest in effect on the total amount on the date that the refund is made? Do you break down the amount and pay what's in effect for each year? Very, very good questions. Before it said, the amount of the refund shall equal the amount of the claim so allowed, plus with respect to claims for refund filed after December 31, 2001, interest at 4% from the date on which the taxes were paid or payable, whichever is later to the date of the refund. This date of December 31st, 2001 was inserted because there was a rate change at that time from 6%. So it was really clear at that time that if the claim was filed after 12/31/01, that 4% interest would be paid on the full amount of the refund due, and there would not be any prorating of the amounts per year to the corresponding interest. The amendment in 2012 did not address this issue of change of rate and its implementation. It just retained that old language. And of course, that language was open to some interpretation. And at the time, for many of us, historically, it seemed to suggest that the interest amount seems to rely on the date of the claim, especially when you take into account the history. But others, and I'm looking back specifically at one person there, but there was more than just one person. We're questioning this, and because we know the legislators, they changed their intent over time, so it was something that needed to be addressed. So effective for July 1, 2013, IC 6-1.1-26-5 was amended, and it reads, when a claim for refund filed under Section 1 of this chapter is allowed, either by the County Board of Commissioners, the DLGF, or the Indiana Tax Court on Appeal, the claimant is entitled to a refund. The amount of the refund shall equal the amount of the claims so allowed, plus, with respect to claims for refund filed after December 31st, 2001, they did not take out that language, so don't get confused by it. They just didn't take it out. Interest at the rate established for excessive tax payments by the Commissioner of the Department of State Revenue. Now here's where they did add, the interest shall be computed using the rate in effect for each particular year covered by the refund. So that makes it clear, or at least clearer, that it will be for each year, the interest rate in effect for each year. So if a person claims in 2013 is entitled for a refund on an overpayment made in 2012, you would calculate the refund and then apply the rate in effect from the date when the tax was paid or payable, whichever was later, to the date of the refund. So you would be using two different interest rates. For 2012, that would be 4%. For 2013, that would be 3%. And when we look at the form, it'll be a little bit clearer, I think. The interest rates, by the way, can vary widely. For 2010, the rate in effect was 4%. For 2011, it was 9%. For 2012, it was 4%. And of course, for 2013, it is 3%. What about for those claims that came into effect or came to you after June 30, 2012, but before July 1st, 2013? Because these laws are in effect, they're not retro, they are in effect as of July 1st, 2013. So a good case can be made for paying based on the rate in effect on the claim date, as there is historical support for this, and we won't take audit exception to that. However, this is a part that could be litigated, so I would definitely be consulting with my county attorney about which direction that you need to go. The other issue raised was that last year, the interest to be paid under IC 6-1.1-37-11 was not changed. It still stated that it should be at 4%. And there have been questions as to when IC 6-1.1-37, which is a broader statute, would be applicable versus IC 6-1.1-26-5, where it was changed. And obviously, if you're under 26, then that the 26 change would be applicable. But there are times where there's a little bit of confusion especially when there's a claim brought under IC 6-1.1-26, and it results in going through the appeals process under 15. So we talked to some of the auditors about this, and I got kind of a variety of answers on that. I think this is something that State Board of Accounts and DLGF auditors state we're going to have a little bit of a discussion, to have a little more uniformity, to put out what our position is on this. But in the meantime, with the change in the interest rate, if you have the same interest rate going under 37 and under 26, at least to the taxpayer, that person will be made whole in the same way. So the interest rate was changed under IC 6-1.1-37-11 from 4% to the rate established for excess tax payments by the Commissioner of the Department of Revenue. And it also adds under there, so that there is a parallel consistency again, that this rate in effect will be used for each particular year covered by the refund or the credit. So again, it's going to be each year that the refund is given back. The other change I'll mention here is that IC 6-1.1-37-9 was also amended. This is when a taxpayer must pay additional taxes at the conclusion of appeal plus interest. And last year, the interest was changed from the 10% to the Department of Revenue rate. And then this year, it was added that the interest shall be computed using the rate in effect for each of the years. So now all three of those areas are parallel. Okay, why don't you pull out your handout. My, that is nice and big. Now you'll notice your handout doesn't have any numbers. Mine does, and I know there's some purists out there who are going to start immediately taking out their calculator and whipping out those numbers. No, don't do that. They're not going to be right. I know that. The numbers are just to show you the flow, okay? See, that's an auditor is admitting that she is wrong, okay? Okay, let's see how the 17T was modified. You'll notice that the top portion on how to calculate the amount of refund has not really changed. It has been updated in the sense that the old prescribed form didn't have all of the columns in place, but I think that your vendors and you have all been using it correctly, and so we just kind of caught up to date on that. Let's see. We've added the circuit breaker column, and we've also made a change. You still have the less property tax replacement credit, and you still have the less homestead credit columns have remained, but added to the homestead column is an and/or for residential PTRC, and because this is a new credit since the last form revision, so that's a little bit different too. So the first two sections you'll see basically are what you're used to. You have the amounts paid and the amounts payable so that you can come up with your refund amount. As you can see, The main change is in the third section. And this is where we made it so that the rate of interest in effect for each period, for each installment, is lined out for you. So I had taken, you can see on the very first line, that's your refund for each installment. You get that from taking the first section and subtracting out the second section. Really absolutely no different than what you did in the past. And then what you see is we have each year we'll go, in this particular case, we had, let me see, I think, you can see that we had refunds. We had 2 different installments. One was at 6/20, 2011, and we had one at 11/5/2011. And so we came down to the total amount paid, and then we had the actual amount paid. And then based on that, we know that under the first column is the calculation by days, and for the first installment, so we have the year 2011 at a rate of 9%. We insert the number of days, and then we calculate that to the interest. And then we have to go down to 2012 and do the same thing. There I've got 365 days. Some of you may be using 360, which is a common business practice. All we ask from you is that you use a consistent basis for the number of days. And so you just go so on down there until you come to the total amount of interest, and then you can come under the total column, you'll have your total refund and your total interest. So I think the form is really it's straightforward. It is a lot of calculation just because you're using different interests, different number of days for each year that the installment, that it's applicable. As far as the bottom section, that talks about the different reasons for it. We did add before we always had the 3 reasons that are under IC 6-1.1-26-1, which are still numbers 1 through 3. And then on number 4, we added refund credit as provided under IC 6-1.1-15. And again, the reason we did that is because I know some of you are actually utilizing this form. Some are using it as your basis because you still, even if they don't have a quote-unquote claim or it's all credit, you need to have documentation support, and you're utilizing this form or something similar to it. So we added that in there so that you would have that as a reason if that is the reason for that. And also, the final one is still the same. It's the invalid tax sale, which would be for your 6%. And of course, that would still makes it a little complicated, but at least you know for the tax rate, it's just straight 6% on that. So hopefully We will be getting this form out next week. That's our intent to do that. And I think that it does, I mean, it's not applicable until July 1st, obviously, but at least we'll have that out there to you in preparation.